Well, hey, everyone. Welcome to another episode of another video of weekly lives. So today we're going to be talking about dividends, right? Dividend. I just knew that some of you in the group are actually active on dividend investing. It's your favorite. That's awesome. Seriously, that's awesome. I mean, I have been a dividend investor since I began, to be frank. But the only reason why I ventured into growth is because of lesser capital from the beginning, right? So I always believed in dividends. The reason is because I always believe in passive income. Everyone loves passive income because they don't want to work for, end of the day, how long you can work, right? So that's what I aimed for last time. That's what I was hunting for. And I wanted to actually just get a good decent amount of passive income per month or per year. But then again, when I dived into the market more and find out more deals, finding out more about the game, right, the stock market game, I found out that capital gains end of the day is still the best, obviously, right? And dividend is too slow, especially if you are having just like 100K portfolio or 50K. But that being said, that's where we have to compound, right? So today we're going to be talking about dividends. What do I personally look out for in dividends? For dividend stocks, what do I look for? We'll be talking about the market. We'll be talking about the power of compounding dividends. The market is because we want to be in comparison and comparing the sort of products, right? So we got growth stocks, we got dividend stocks. How does the market work? Like, if the market goes down, you can buy anything. If you want a more safer net, then obviously you go for dividend stocks, but depends on what type of dividend stocks, right? So anyway, let's begin. I'm going to be sharing my screen. So here, sharing my screen here, and basically about the type of stocks. Now, there's a few things to take note of dividends, right? I'll go step by step. Number one, what is the first thing that I look at when I talk about dividends, right? I want to look at whether or not, as usual, is similar to any sort of industry or any sort of company that you're looking at. Number one, do you understand that business, right? Because we all know for the range of dividends, it's all about utilities, right, that give good dividends, right? REITs, real estate investment trusts, right? Consumer staples, even Apple gives 2 to 3%, right, on the yield. Banks, financials, right? So we have to understand, why do they give out dividends? It's very simple. They want you to buy their stock, right? They want you to buy their stock. So don't be tempted by these sort of, we're going to talk about the pros and cons, right? Don't be tempted by high dividend stocks, right? The only reason why you're giving out dividends is because you want to attract shareholders and you want to benefit shareholders, right? Shareholders that have been working for so long in this company. Obviously, you want to give them good dividends yearly because they deserve it. They've been working hard. Okay, let me give you a yield. Let's say if you buy at this price, a yield of 7%, a yield of 6%, right? Now, it all comes to play when we talk about dividends that, in my opinion, Southeast Asia or Asia, they love dividends. Singaporeans especially, right? Malaysians, Singaporeans, we love dividends. Why? Because we love passive income. We love doing nothing and just collecting money. Everyone loves that. But when it comes to the types of dividends, then we'll be talking about REITs, which is popular, right? REITs, real estate investment trust. What REITs? Malls, right? Hotels, all these sort of things. So why am I saying that? Is because we need to understand step number one again. Going back to step number one, do you understand this business, right? How do dividends work? Let's talk about REITs. REITs, basically, you have a shopping mall, you construct a shopping mall, you open another firm, you turn it into a REIT. That means it's an investment trust. All of the rental income from that particular building will be transferred to as returns, right? As dividends paid to shareholders, owners of the REIT. 90% of that will go there. And that's how they earn. Basically, is on rental income, right? So that's why we have to see the occupancy of that building. What is the history of the occupancy? We have to go to the building to see whether or not is there a lot of traffic, right? What are the shops there? What are they doing? Are the malls going to be competitive? I'm talking about Malaysia and anywhere else in the world, right? Is it competitive? Why do people shop there? What's so interesting? That's the part of the DUD, right? So if your DUD is solid, you understand the business, and REITs normally they don't just have one mall, right? Unless it's a huge GTV. They have several products in their portfolio. So we have to understand each and every one of them, go to the physical building, see the traffic, see the occupancy, see the rental, and okay, boom, it's a solid investment, right? Then you got to ask yourself, right? And that's part of the first step, right? Treat it as the second step. You need to ask yourself, how long can this survive? Because when it comes to dividend investing, we need to ask ourselves, how long do we want to play in the game? Now, we all know that investing is all about long term. I don't care what you say. You're a trader. I don't care. Investing is all about long term because the magic works after the 10th or 20th year, right? So you need to ask yourself, will this mall be, or these hotels be there for 20 years in, right? So I live in Malaysia. I'll be like, okay, Sunway Mall, right? It's one of the famous malls in Malaysia. Pavilion. Will this mall be attracting tourists? What is it special for? Will this still be here? Will the traffic still be there? People want to upgrade their lives. Okay, there's a lot of Chanel's, Dior's, all there. Right. People want to upgrade their lives. People still want to be, it'll still be there for 20 years, for sure. So that's the first step. The second step is what's the occupancy rate at downturns? So what happened in 2020? 2020 was a little black swan, is a little different. But still, we got to identify whether or not people are dumping this stock during 2020. There are certain rates that people do not want to dump because they are long-term shareholders. We identify those rates, we'll be like, oh, it's all good, right? Another black swan comes, it'll still be holding. Well, of course, it depends on the scenario. COVID is a special case, right? All retailers are affected. But at the end of the day, during a downturn or a recession / depression, how well did this mall do? Obviously, we know that people will still be going less because their spending power is not as much during a recession. But how does it fare? Can it survive? Right? Is the free cash flow good enough for this mall to survive? How is the management? Right? How is the management? How are they managing this mall? Are they doing a good job? What is the free cash flow yield? We're going to talk about that, right? Free cash flow yield of this particular company. Now, free cash flow yield basically means the free cash flow per share versus the market value per share, right? It's a financial solvency ratio. We want to know how good, I mean, the higher the better, right? What is the normal rate? Around 4 to 5%. But why am I bringing this up is because we want to know how well this company, this rate, or any other product that is giving out dividends, what is the good cash flow, right? What is the good free cash flow? Because if the yield, preferably, you want to have a 2% higher free cash flow yield above on the dividend yield, right? That's why I have this page actually open up. So the first step is done, right? Identify what you know, what you understand about the business, how long can they last, all this good stuff. The second thing to know is what is the history of their dividend payout? Have they been paying out dividends for 10 years consecutively? I personally look at 5 years, but 10 years is good because it actually factors in the recession, right? And by the way, a recession is coming. This year and next year is the time to build generational wealth. Always remember that, okay? Value creation, wealth creation is now, right? So anyway, back to dividends. So back to the second point. You want to know how long they've been paying dividends because you want to know whether or not it's safe to go in. Again, it's a long-term investment. What does the management say, right? Will they suddenly say, okay, I'm going to be cutting off dividends because of this? Now, we have to understand, dividends comes from earnings. Earnings is net income. The company has to be profitable and strongly profitable to be paying out dividends, right? So tying back to the second point, what is the dividend payout ratio? Is it 50%? Is it 30%? If they pay out too heavy on dividends, not talking about rates, if they pay out a huge amount of payout ratio, it wouldn't be healthy for the company because everything is benefited by the shareholders rather than the company itself. The company needs to roll. Unless it's a stable company, not really growing in terms of innovation, then it's fine, right? But we need to know the payout ratio. The lesser, the better, because even if they can pay out a 30% payout ratio and give us a yield of 7%, then obviously that's the best, right? But some companies, you will see that the payout ratio is around 40%, which is fine. But we got to know what's the payout ratio, right? It ties back to number one, whether or not this company can survive, right? Whether or not you understand the business of the company enough, and then can it survive? What is the payout ratio? Yada, yada, right? Basically, it's all about survivability because you want to be holding these dividend stocks, which is a safer asset, especially at whatever time, right? The best thing to know about stocks and managing risk is, will they survive a downturn? Do they have good enough free cash flow to survive downturn? Do they have good enough cash flow in the bank, cash in the bank? So when it comes to dividend stocks or any other stock, it's the same thing. We still look at financials. We still look at how much money they have left. We still look at the free cash flow yield. We still look at dividend payout ratio, right? All these good stuff, right? So that's the second thing. The third thing is, which sector are they in? Are they cyclical? The third thing will actually relate to what is your entry point, right? So yeah, you can tell me that, okay, Warren, my yields are going to be attractive as hell this year because all the stocks go down. That's true. That's very true. That's why generational wealth is actually, starting today, right? Starting now. But the point is, we also have to assess different products, right? If you have dividend money parked aside for long-term investing, just for dividends, right? Your mentality has to be ready that this is a safe stock. This is not volatile. You're not expecting it 100% in 20 years, right? I mean, actually you could 20 years, sorry. 100% capital gains, right? Or 100% in 5 years capital gains. No, because this stock has, this company, the value is there, right? It's not growing. It's just dividend is safe, right? Safe. So your mentality has to be ready enough for that. The second thing is, because when we talk about all the stocks going down, you could argue that, hey, everything is going down. Why not a time frame on growth versus 5 years? Let's argue as the product, because that growth stock might go down even more during the recession. And then, in the end of the day, we have to capitulate, right? So we have to know different products. We have to get our mentality right on that particular stock. I love dividends, right? But I can tell you, my 7-figure portfolio is not revolved around dividends. Why? Because I aim for capital gains. I'm managing family office. So my family funds is actually, because they're safer, that's what they want. Okay, I'll be managing dividends. What do I invest in? I invest in REITs, right? I don't invest in bonds, right? Some people give bonds, in Malaysia, 30-year bonds give 5% yields, right? Industrial REITs is what I'm aiming for. Being in the property line for so long, I know that industrial is the way to go. Why? Because it's just a shell. You're building a shell of a building, right? You can lease out more than 5 years, right? Good rental occupancy. The businesses in the industrials are making money, right? Logistics, especially. So it ties back to number one. If you find out that the business is making money, right? Especially at these times, right? It's not too cyclical, then okay, it's a safe bet. You can invest for the long run. Yep. But being an investor, you can just sell and choose other. That's the benefit of us, right? Me and you. We can buy stocks today and sell stocks tomorrow. Obviously, that's not what I recommend when it comes to dividend investing. But we need to update. It's not as simple as just buy and hold, right? We need to update quarterly, yearly, whatever the hell. But you need to know about the business. You need to know what's in the market, right? Logistics business is performing exceptionally well this year, last year, right? So this is a good business to have for yields. So that's why number one in this website, you got Industrial Logistics Properties Trust at ILPT and 9.8% yield. Free cash flow at 12%. That's crazy, right? Now, Realty Trust, all REITs. You see here, Medical Properties Trust, all REITs giving good dividends, right? In Asia, same thing. REITs give the good dividends, 6 to 7% anytime, right? Then you can even benefit off the upside, provided that you buy at good prices, right? Then you got Bancorp, you got Energy, even Devon gives 6.2%, right? Energy. That's their style now. Why? Because they're earning a lot of money, right? All prices are high. They get good income. They get good net income. Okay, they pay dividends. They pay the good dividends because they've been waiting for so long to earn this money. Let me just pay out good dividends. But it's highly cyclical, right? When interest rates are low, all prices is going to go back down, right? So it's 120, 140. Well, it's going to go back down, right? Is it going to go back down to 70 levels? Yes, it will. So is it a time to be holding oil stocks back then? Well, for dividends, not really, because there's so many products that we can have. So it ties back to number one. We need to know the game. We need to know the business. We need to know what's happening. What type of rates are we buying? What type of dividend investors are we buying? Yep. So that's number three. Number four is the power of compounding is crazy. We all know, right? This is the compound interest calculator. We all know it's crazy because it's the same as stocks. You got an initial investment of 20,000. The name of the game is we have to keep on pumping in money. In our case, we have to keep on reinvesting the dividends, right? So what I do is two things. I put my hard-earned money back into the stock market to be compounding on the asset. The second thing is whatever dividends that I have, I reinvest it back into the same company. Why? Because it's a compounding effect. Like I said, number three, we have to be mentally ready that this is a compounding machine, right? It's for your kids, it's for your retirement, whatever you want to call it. In 20 years' time, you'll be rich. Why? 20,000 initial investment, 1,000 monthly contribution in a length of 20 years. And let's say your estimated interest rate on all your rates on average, right, is 7%. By the 20th year, you would have pumped in 260,000 in monthly in total contributions to get back 569K, right? Your initial investment of 20,000 will be 569,000. That's the beauty of it, right? That's the beauty of that's the beauty of the compounding machine, right? So it's dividends overall, and it's a compounding machine, but we have to be patient. That's number four, which is hard, right? So let's say you got like a growth fund already ready up, right? Prepared. That growth fund is supposed to yield you probably rate of return, ROI of IRR, right? Yearly return rate of 20% or 19%. But when you're investing in dividends, suddenly for the whole year, you're like, oh, step four is the most important because it's mental, right? So you're looking at 7%, and you're like, shit, why didn't I just put that into Tesla? Which makes sense. But again, mentally ready. You already set aside your money on dividends, right? So don't have that FOMO effect because the volatility, right, is lesser than other companies. So you got a company like Tesla, which is a high beta stock. Some people call it a meme stock. That has capital gain, right? Growth, because you know that the market cap will grow well. And I don't argue, it will do well. But if let's say it goes down the drain because of a recession, your rates obviously will go down only 5%, and Tesla will go on 30%, right? So you need to know the pros and the cons, right, before you go FOMO. So again, number four is important because when you want to compound your money in dividends, we have to be patient. Set aside probably, they teach you all the way, right? You can see it anywhere. Save up 15 to 20% of your income into investments. So how many percent of that 20% will go into dividends? Slowly accumulate, right? So that's the key. When it comes to dividends, payout ratio, what is the business? Number one is what is the business, right? Is it something you understand? What is the occupancy rate? What is how is the management like? What is their decisions? Do they suddenly give out special dividends? I don't like that, right? I like, plain and simple, slow and steady. What are decisions, right? What is the payout ratio? Obviously, again, you guys let me know in the comments, right? What else do you guys look for when it comes to dividends, right? We talked about free cash flow yield. We talk about how well are they paying dividends overall, dividend history, right? How long do they pay? So you can expect when you can receive your cash if you are just living off dividends, right? We talked about the type of dividends, right? Rates, industrial rates are the best, right? When you talk about Malaysia's atrium rate, right? Industrial. I love industrial because again, it's cheap to build, right? You got good rental, you got long occupancy, you got loyal clients, loyal tenants, basically. And again, it ties back to number one. Will they remain here for 10, 20 years time? Right? That's the most important. So identify your duration of long-term, investing, long-term dividends, how long you're going to be holding for, expect your dividend yields and compound it. That's the magic, right? So again, hopefully you guys enjoyed this video and I'll see you again next week. Bye-bye.